Hello guys, another video. It's Friday, 6 p.m. I've got my disclaimer right there at the bottom. You read that real quick, please. I'm not a financial advisor, you know this. Anything I say is my opinion and is not a direct order for you to act. It's your money, your responsibility. Trade responsible. Period. Charts, let's go. This is gold, one daily time frame. Humongous push the upside, but I must say that there's something driving the markets right now, and that's very unfortunate. I say it from the bottom of my heart. I don't like this word, but it's driving the markets, and specifically gold. It is very sad what's happening, but my video is not going to be about that. I just need to say it because it's not typical what's happening. That's the thing. So most and a lot of trading strategies are not working. There's a lot of pressure besides the technical and the price action that's happening. That's why in one day gold moved what it moved a whole week last month when it was falling. And so I'm just gonna do this very quickly. Where do I see gold next week, or at least in the near future? As you can see, I have a very important psychological price levels. This obviously the support we're bounced off of, which was 1805, the 1805 range to the 18010, 1809, I'm sorry, 1810, 1815. The minimum was like 1811 something, and that's where it bounced. This candle is not actually there. Remember, there's a gap. There's a gap from here to somewhere around here. So this wasn't perfect. There was a huge gap. People were expecting it to close back toward the bottom and then rise, but it didn't do that. And I'm going to illustrate what I see happening from here when it opens. I expect price to come into this range of 1943 to 1952, 51 probably. And then I would like for it to consolidate there for a little bit, because Mr. Paul is going to speak on Thursday. And so what that could look like is for a swing low to make a pullback out of all this big range that from here to here. Just make a swing low over here somewhere. And I honestly would like for it to be around that price level of 1908, 1905 to 1908 is where I would like it for it to then bounce back up and reach these previous resistance areas, but manage to break through them without much trouble to later use them as support to then retest its near highest highs historically. And this is like my favorite idea, because also what I'm saying, the unfortunate events that are happening that's moving the price with such strength that means that the pullbacks that the market attempts to do aren't going to succeed that much. They're going to be very fast and immediate reactions. Notice these pullbacks, there was very little immediate reaction, very little pullback, huge reaction. So the market has, I can say, more strength than it had when it was falling down. So that being said, expect price to continue breaking up unless there's a clear change in direction with evidence in regards to its candles and the actual break of structure. Okay, I know what must go up must come down, what goes up must come down, But it's not always the case when there's a war going on, unfortunately, and you're talking about gold, which is a which it is a it's it's a precious metal that people usually and always have been acudir. This is in Spanish. In English is you tend to you just tend to seek um protection buying gold, right? And saving money and stuff like that. So that's what's happening. Um, we cannot ignore this resistance where prices managed to pretty much close at on Friday. Today is Friday, 1930s, 1930 to 1932. So if by Monday the price doesn't reach this area, it might want to do this pullback throughout the beginning of the week and then possibly make a the retest of these resistance. But the reason why I like this is because I'm also the equation I'm using, right, for this, like the mental equation is I'm taking into consideration the fact that the Fed is going to come out on Thursday and talk about its recent um, wages raise and unemployment change. So they might also talk about the future, the near future in regards to their rates, their interest rates, right? So that also tends to move the market a lot. And because we have been seeing positive news for the US and the dollar, we might see a hawkish speech from Mr. Paul, and that would mean that people feel positive about the US economy, about the US dollar, and what tends to happen with gold is that it also uh, it it makes it just makes movements to the downside, right? It loses strength. However, I doubt that it's going to have much impact, or I should say that is going to have more impact than the actual war, right? So that's why I don't see this pullback going too far down. Okay, because the minute gold makes a slight movement to the downside, in my mind, it's just, people are just going to jump in at any opportunity they get to buy. So, like I said, this is the way I think and I interpret the market. And obviously, everyone could be wrong anytime, but I am positive in regards to how I interpret things. I've managed to make quite pretty accurate projections if you follow me and you keep up with my ideas and projections, especially on Instagram. I want to go real quick into the cup and handle pattern that I saw, and you'll see it better in the 15-minute time frame. And if you know about chart patterns, you'll see this very quickly when there it is. Okay, so I was looking at this right here, and I was like, man, that looks like a perfect, like U, the half of a U, right? And immediately, it's cup and handle. There's a little handle. It's very short, small, but it is there, and it's very powerful. Cup and handle patterns are, like head and shoulders, one of the most powerful patterns. Why do I say powerful? What do I mean by powerful? Well, it number one, it so powerful patterns. I'm gonna write this. Number one is like the degree of which market respects. Number two, risk reward. Number three, I would say, yeah, like that's pretty much it. Just these are two like key uh, factors that you can define a pattern being powerful. For example, the symmetrical flag. The symmetrical flag is something like this. You have an impulse, then you have your symmetrical triangle, and then you have a second impulse. Okay, and the rule of this is the distance of the first impulse is will be the same distance of the impulse that comes after the breakout. Now, the thing with these symmetrical flags is that the breakout could be up or down. Usually it's in the direction of the first impulse, but these patterns, they have fake outs. That's what I'm trying to say, is like the market would start respecting them, but then it would probably do something like this. Huge manipulation, and then the continuation, right? So that's where people tend to like kind of um I'm not gonna say fail in trading them, but have trouble with. Whereas head and shoulders, for example, you know, the head and shoulders is very it respects it. It's got symmetry. Like people usually it works, right? There's not much trouble to it, and this is the symmetrical pattern. You have a neckline. You have head and shoulders, the shoulder, head, right shoulder, and you have the rule of where the support, whenever it breaks, the market trades to it. Sometimes it trades to the neckline, but this happens and it respects, and it's very clean. There's not much of like fake outs and stuff. And like that, head and shoulders, there's the cup and handle. And it's a very, very interesting pattern because I'll show you that your risk reward is amazing. Okay, I have to kind of adjust this so that you see it right there. And I know you can see it immediately, like wow, the market, like from this point on, never had the slightest manipulation or stop hunt or liquidity grab or whatever you want to call it, order blocks, or it just went up, 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 up. And that's what happens in cup and handle patterns. The cup is perfect, like it has a curve like behavior where both down and up. After the handle and the breakout, there's a pullback and just a strong continuation movement. So stop loss, just think about it. If you entered anywhere within this range after you saw the breakout, for example, if you have this range right here, this little range in the 15-minute time frame, as soon as you saw market break it with this candle and this making the pullback, anywhere here, if you buy, textbook says put your stop loss under previous lows on a buy position. And that would have worked perfectly. And you could have said, oh, wow, the distance from here, anywhere just down here is my decision on how much I want to risk. But it's one of the moments in which you can say, okay, since there's not like a wick over here or like, there's not like a low a bit more in the past that the market might want to trade into and then go up, I can put my stop loss way more tight, and that allows me to use a bigger position, and therefore my profit is going to be bigger, right? There's going to be more profit. So that's also your number 2 risk reward factor that defines this pattern pretty powerful. So anyway, back to where we were on our general bias and upcoming projection. And just to finish this also, because I don't want to take too long, what could we expect if this isn't the play next week? Because maybe the momentum is so strong And you know, wars, I mean, they they either get better or worse by the minute. So anything can happen this weekend, and the market might open with a bigger gap than it opened in the past this week. So we might see another gap. We might see another opening above, probably on that resistance or even above it. So if that's the case, whether there is gap or not, and price just immediately breaks these resistance at levels, then expect it to come and rebound off of this area, make that pullback, and probably want to fetch that maximum high. And then the Fed speech might make it kind of return and breathe a little bit back into this range to where the market had consolidated all this time. So I'm going to put another kind of range, which was this one. Okay, so break out of range, trade into the range again, this range. We are gonna, you know, if you see my videos, you know this is something I like to do. I'm gonna divide my range into two, the 50%. So that's where market could stop, kind of dance with the 50%. If it breaks it, it'll dance on the other side. So here is gonna dance under the 50%. If it crosses, it's gonna dance above 50%. And it's gonna go back and forth, searching that 50% area of the range. So 50% range would be, let's put it right over here. I just take a little bit, you know, just a little. Let's try to be a bit, you know. So this is the range I'm talking about. Right, so yeah, that's what could happen. Um, if the market doesn't consolidate and there's not that Fed speech pullback, I guess you can call it, maybe the price opens with another gap, just how it did at the beginning of this week. Potentially could be there. Continue to fetch these highs, maybe try to close the gap, fail to do so, maybe because of the strength it's been coming up with, and then just continue this huge nerve-wracking war-based uh, you know, movements. It's unfortunate, but it's just how markets move, especially gold. So yeah, I don't think it's gonna break so hard the 2050 psychological level. There should be a decent pullback, but that's just, you know, that's pure. That's too far and that's too much for me to clearly say something about it. This is what's more logical to me. A small pullback wherever that is, but continue to see price looking for previous resistance. Okay, so there it is. I'm gonna leave it there. If you wanna take a screenshot, maybe copy this map out, I guess. And I'll see you, or I mean, I'll be with you again next week sometime. Okay, I'm gonna be following this. So thank you guys. See you next time.